Have you ever felt like the financial markets are speaking a completely different language? With all these different pieces moving at once, it can be confusing. Well, today, we're going to learn how to decode that language. We're going to listen to the market's hidden messages and see how all these different assets actually talk to each other.
All right, welcome to AI Explains ICT. In this video, we're breaking down the core content from ICT's Month 5, Episode 9. Now, we're going to cover some really dense but incredibly useful information, so I'd really recommend grabbing a pen and paper or opening up a notes app. You're definitely going to want to remember these concepts.
Okay, here's the game plan for today. We're going to start by figuring out how to find clues in all the chaos of financial data. Then we'll break down the 4 core markets that are really the foundation of this whole analysis. After that, we'll look at which markets move in opposite directions and which ones move together. I'll even give you a handy cheat sheet to tie it all together, and we'll wrap things up with a super important reality check about patience and playing the long game.
So let's get right into it. The first step here is learning how to find those clear, actionable signals in what can often feel like just pure noise.
If you're a trader, you know exactly what I'm talking about. Every single month, there's just this flood of fundamental data, right? CPI reports, employment numbers, all these different indexes. And according to ICT, trying to digest all of that and make sense of it is completely overwhelming. It's almost impossible for one person to do it effectively.
But here is the good news. There's another way to go about this. Instead of getting totally lost in that sea of data, you can find real clarity by just listening to what the markets themselves are telling you through their price action. And this approach, it's called intermarket analysis.
And the foundation, the very bedrock of this entire method, rests on understanding the relationship between just four key markets.
Now, what's so powerful about this concept is just how simple it is. ICT explains that pretty much everything you need for a solid long-term directional bias is reflected right here, in the relationships between these 4 major groups. Believe it or not, they are all directly linked.
So, what are they? Well, first, you've got the bond and interest rate markets. Then, you have the commodity markets. After that, the stock market. And finally, the currencies market. Understanding how these 4 pillars interact, that's the whole key. So, let's start breaking them down.
Let's start building our understanding by looking at markets that tend to move in opposite directions. You can think of it like a seesaw. This is where we really start to see the push and pull of the global economy in action.
A really classic inverse relationship is between the US dollar and commodities. Simply put, when the US dollar gets stronger, commodities tend to get weaker. And when the dollar weakens, commodities tend to get stronger. But why? Well, as ICT points out, a lot of commodities are priced in US dollars. So a strong dollar makes things like grains and meats more expensive for other countries to buy, and that reduces demand. A weak dollar naturally does the opposite.
Another huge inverse relationship is the one between bonds and commodities. Now, when bond prices are going up, that means their yields, or you can think of them as interest rates, are going down. This usually suggests low inflation, which is bearish for commodities. On the flip side, when bond prices fall, yields rise, suggesting that inflation is picking up. And that's an environment where commodities tend to thrive. In fact, commodities are often the very first place you'll see those signs of inflation pop up.
Okay, so we've covered the opposites. Now let's build on that. Let's look at the markets that tend to move in the same direction. This is all about finding confirmation for your ideas and analysis. The most important positive correlation to understand is the one between bonds and stocks, and it follows a really clear, logical path. First, bond prices rise. As we just learned, that means interest rates are falling. And what kind of environment do stocks absolutely love? A lower interest rate environment, because it makes it cheaper for companies to borrow money and invest in growth. So therefore, when bond prices are in a solid uptrend, the stock market tends to rise right along with them. And this illustrates a massive takeaway from ICT. The bond market often acts as a leading indicator for the stock market. Think about that. If you're a stock trader, just watching the long-term trend in 30-year Treasury bonds can give you a huge edge and a whole lot of confidence in your long-term directional bias. So, we've gone through the inverse relationships and the positive correlations. Now let's put it all together into a practical little cheat sheet you can use as a quick reference guide.
This table gives you some really specific, actionable relationships to watch. For example, if you're bullish on the US dollar index, you should probably expect gold to be bearish. If you see gold starting to rally, look for bullish confirmation in the Australian and New Zealand dollars, since their economies are heavily tied to gold. Seeing a bullish trend in crude oil, That's typically bearish for the US dollar versus the Canadian dollar, since Canada is a huge oil exporter. See how these relationships help you confirm your analysis across totally different asset classes? It's powerful stuff.
Now, before you rush off to apply all of this, there is one more critical piece of the puzzle we need to talk about. And frankly, it's the most important one, the timeline.
It's a natural question, right? Okay, these relationships are great, but how long does it take for them to actually play out? The bond market might be turning, but when is the stock market actually going to follow?
According to ICT, the answer is a lead and lag time of about 6 to 12 months. Let me say that again because it's important. 6 to 12 months. This isn't about finding signals for your day trades. This is all about understanding the big, long-term macro trends. Patience is absolutely essential here.
And this quote from ICT just sums up the power of this approach perfectly. By understanding these intermarket relationships, you can get to the same long-term conclusions as a fundamental analyst, but you can do it without having to spend endless hours wading through all that economic data. You're basically letting the price action of these major markets do all the heavy lifting for you.
So the final thought I really want to leave you with is this. Now that you have the key to decode the market's secret language, what is it telling you right now, today? Go pull up the charts for bonds, for the dollar, for commodities, and for stocks. See what kind of story they're telling you about where we might be headed.
I really hope you found this breakdown valuable. If you did, please do me a favor and hit that like button and subscribe to the channel so you don't miss out on future videos. And if you have any questions at all, just drop them in the comments below and a real human will get back to you. Until next time, I wish you safe trading.